Good afternoon. Thank you for joining us today for our Lunch with Lou and Andrew webinar. My name is Jimmy Bassett, and I am a managing advisor at Altfest. Today, we'll be joined by Lou and Andrew. Lou will be discussing his outlook for the markets and the economy, and then Andrew will discuss how we are positioning portfolios given what we see on the horizon. After the main points are covered, I will ask him a few selected questions that our clients have submitted. We expect today's call to last about 45 minutes, and a recorded playback of this webinar will be available later should you wish to listen to it again. Now, it is my pleasure to introduce the Altfest.
Okay, thanks. Welcome, everybody. It's great to talk to you today. If we held our talk outdoors, we would be guaranteed to have a heated discussion. But I'll substitute for that hopefully a stimulative discussion. That is my aim, and certainly it's true for Andrew as well. So we're going to discuss the outlook, including the economy, stock market, bonds, and alternative investments. I will spend some time explaining to you why corporate profits are the most important factor in establishing stock market prices. I will show you how corporate profit margins have progressed over the past 30 years. You may be very surprised about that. I will begin with the question, what would you rather have today? I'm going to give you two choices. Inflation is on everybody's lips today. Usually comes about because of a shortage of supply, often accompanied by robust demand. On the supply side, we have restrictions on oil and gas and not enough workers because of COVID sickness and being close to full employment. On the demand side, large US government spending and easy money policies brought about by Fed policy creating more money available at cheap, low interest rates are some of the reasons that people have been able to spend sizably. Now, I'm going to give you, I want to put inflation in perspective. You have a picture there of inflation. On the left-hand side is the beginning of 1972, and on the right-hand side is the present time through June 30th. Notice something. The inflation figure is not as high as it was before. And if you look closely, you had like a double dip in the left-hand side. And if you look even more closely, you see that it took a period of, I don't know, 10 years from the beginning to the end. Why was that true? It was true because Carter had no real perspective on the president at the time on the difficulty of inflation. And so it took, he didn't act quickly. Our president now, and more importantly, the head of the Fed, has already started to move up. It's not going to be as embedded. The net figure is, it should not be as embedded as it was 10 years, about 40 years ago. With inflation now running at high single digits, it is psychologically and practically disturbing for many households. For you, they have forgotten that the old and new administrations both helped create the acceleration of government spending and economic growth, which contributed to the inflation. As one positive example, government spending can be useful for emergency needs, for example, COVID, which is what we used it for, and to support those losing their paycheck. growth in deficit spending that keeps pace with overall economic growth can be fine. However, once government spending strongly exceeds growth in the economy, then taxes need to rise. And I don't think that's in the picture right now. When you have spending beyond benchmarks with no current intentions to repay the money borrowed, you have another reason why inflation is likely to occur. The Federal Reserve, an independent government agency, is not responsible for deficit spending. The federal government is. But it is responsible for years of keeping interest rates low, so low that borrowing costs have been cheap, and stock markets are able, in that situation, to jump higher with little competition from bonds. These excesses cannot continue with the economy running out of capacity. The limitation on labor capacity, as one key example, has made it difficult to attract qualified people for jobs. Something had to be done. It is now being done. The Federal Reserve has raised interest rates. It says its goal to slow down is to slow down consumer spending. Not that long ago, people had happy days with money in their pockets helped by government handouts. At this point, with so many costs moving up and only a few, such as fuel costs and selected other commodities, coming down, the Fed has to be concerned that the previous attempt to have a mild slowdown is not going to work. They will likely continue to raise rates more rapidly, maybe with the intention of creating the R word, recession, but never admitting it. It may be necessary for the recession to bite over time to cure our inflationary problem through eliminating shortages. How long will it take to deal with inflation is difficult to say. For example, nervousness on the part of the consumer who look up to find that stocks continue to be weak may lock up their wallets quickly, causing an early recession or stocks weakness on the other hand, or could be ignored by other people with large savings that will continue to spend. On balance, a slowdown and a possible recession should occur within the next 9 months. The optimists, of which there are many, say any recession will be quick, a quickie, without much impact. However, too quick, and we could be back with the same stimulation or the same situation a year later. Stock prices have come down sharply. No longer do both younger and older people think they have discovered the keys to the profitability stock market kingdom. Assuming no recession and a realization of projected corporate profits, stocks, yeah, you'll be interested in this, but I'm going to be taking it away from you in a minute. Stocks are largely close to fairly priced. So that's what I said. They're largely close to fairly priced. However, there are a few caveats. First, stocks don't usually stop at fair prices like a stop sign for a speeding train or something. They usually decline even more. Secondly, any further rise in bond interest rates is likely to create more competition with stock market investing, creating a greater stock market weakness. Finally, the stock market is more closely fueled by current and projected future earnings. And I'll talk a little more about that. Now you have your diagram there. Here's the surprise. It should be a surprise to you, and in a way, it's a surprise to me. These are what you have, what profit margins are simple. They're profits divided by sales, like if you owned a candy store or a stationery store. How much you brought in versus how much it cost you to sell. So the profit margins in in the diagram at 1992 were 4%. That's what you made. 4% profit margin. Now look what's happened. Look how margins, this isn't profits, absolute profits, this is margins. So it's a relative figure. The figure has grown to a point in which it's got 12, 12 to 14%. It looks like it's peaking out for now, but 4 to 14, do you know what that means? Is more than tripled. Profit margins, not in amount, but in margins, have tripled. And the reasons are that corporations are operating more efficiently, but also, I think an important reason is that we cut the taxes on corporate profits a few years ago. So the figures now being thrown around about corporate profits, in my opinion, are too optimistic. As future earnings in the projection are going to move up steadily. Any significant recession, and let's over very quickly, will bring earnings and therefore the possibility for stock prices to move further down. Right now, there's an expectation, actually, there's an upgrade in earnings this year, which is strange to have earnings expected to be higher now than they were 6 years ago when the economy is supposed to slow down. So that's too optimistic. And if that's true, then the valuation of fair price would have to be adjusted down. So other observations are that the consumer is not as negative as the consumer confidence figure shows. After a weak May in consumer sales, June bounced back strongly, although part of it was not more real goods spending, but just the fact that the prices of goods were more expensive. So that boosted the sales. But there was a real bounce back, even with that factor. The Fed would like to scare people into slowing down their spending rather than raising interest rates and running the risk of a recession. That may be best at this time for one reason, because fewer people would lose their jobs. One of the Fed's mandates is to keep people from losing their jobs, as they would in a recession. But make no mistake, if they have to, the Fed will cause a recession. Right now, in contrast to many people's belief of an imminent recession, it may not be right around the corner. If the Fed gives up too early on squeezing inflation, it could make things worse. That's just an observation. The Fed has to be tough if it's needed to be tough. And I believe, as I've said, that they will be. Inflation may have peaked, helped by the decline in energy, but getting inflation down below 2%, that's the goal, and it has been the experience that we've gotten inflation down below 2% for some time, which really helped us. But getting inflation down below a growth rate of 2% without a deep recession will be very difficult. I'm looking for a more mild recession and inflation leveling off over time at over 2%. Stocks have come down over 20%, but relative to other recessions, there is a possibility for further downside. Further, let me give you a further inflationary thought. Inflation is one of the keys, maybe the key. The answer is, to a choice I gave you at the beginning of this talk, amid optimism and negativism and steady growth and rapid growth, is the second choice. That is, to prefer the economy that people are negative about with a slowing growth. Why? Because greater demand for goods in an inflationary period, when we are optimistic, as discussed, just leads to higher inflation, higher demand and higher inflation. I can tell you personally, this is the most serious inflationary problem we have had since the 1970s. I also said it wasn't as serious as the 70s. However, I don't think it will be a big problem as then, as I've mentioned to you. At that time, when Carter was president, it took a new, tough Fed President, Paul Volcker, 2 recessions to lick inflation. Now, this is my personal experience. I would run into him at the corner newsstand in Manhattan. They had newsstands. They still have newsstands. It was a candy store newsstand. He was hard to miss at 6 foot. Paul Volcker was 6'6", always with a cigar in his mouth. I was tempted to ask him whether having a cigar on the left side or the right side of his mouth indicated whether he was considering tightening or easing on Fed policy, but I restrained myself. In sum, we have the possibility of a mild to moderate recession. Rather than focusing on whether we have reached the bottom in the stock market, think in terms of a fairly conservative assumption. I think this is fairly conservative. It is that given the decline in stocks already, if it only reaches the peak again in 5 years, we would have a greater average return of, it would be 6% per year, and it would be greater than to have your money in bonds. So even at today, with an extended, a conservative assumption of not reaching the peak again for 5 years, you have that as a support.
All right. So now that we've heard about the big picture, I think it's time to turn our attention to how we're positioning portfolios today, how the views that Lou shared translate into how we're managing portfolios. But before I go into exactly how we're managing portfolios now, I think it's going to be helpful to hear about to take us to present by starting at what we were seeing at the end of last year. And I think that's going to be very illustrative. So at the end of last year, there was this debate about, is inflation transitory or is it here to stay? And we were more concerned that inflation was going to persist. And interest rates had moved up last year, but stocks continued to perform very well, particularly speculative parts of the market. So parts of the market like technology, cryptocurrencies, meme stocks. There was Robinhood wasn't, as we're learning now, wasn't even able to fill all the orders that it was getting. So we had rampant speculation, and we were concerned that interest rates were going to continue to go up, and we were surprised that interest rates hadn't already interest rates had already started to rise, and we were surprised that interest rates hadn't taken the wind out of the sails of some of these speculative investments. I think you had 10 investments in the fourth quarter of last year that were driving 50% of the returns in the whole stock market. Companies like Tesla. Now what happened? Well, 2021 became 2022. Interest rates started to move up very sharply, and speculation quickly left the market. And the most speculative areas of the market, like technology, sold off very sharply once interest rates moved up. And this has been the worst time for a stock and bond portfolio since the 1930s. Why is that? Well, normally when stocks sell off, bonds provide some cushion because there's a flight to quality. People don't want to own stocks. They put their money in bonds. Bond prices go up. The bond interest rates go down. There's often when there's a belief that the economy is going to slow, then bonds are also, interest rates go down, and bonds are the safe haven. Well, in this case, bonds have, the risk has been that interest rates are going up. So due to inflation pushes interest rates up. And so higher interest rates means lower prices for bonds and stocks as well. And so we've had a double whammy to stocks and bonds, and that's led a balanced portfolio to decline the most since the 1930s. Stocks are down through June. Stocks are down 20%. Bonds are down over 10%. And because we've been making significant changes to portfolios, anticipating a higher interest rate environment driven by higher inflation, we were putting a lot of money into alternatives. We had very little in technology and in the speculative parts of the market, and we had made surgery to bonds. We've had a very untraditional bond portfolio that we've been managing as well, where we've had shorter term bonds where you can get your money back much quicker, that are less affected by interest rates, bonds that are tied to the housing market, and we've taken money in general out of bonds and put it into alternatives as well. Because we've made many changes in anticipation of this environment, we've been able to cushion the blow, and our portfolios, our strategy is down 4% less than a typical stock and bond portfolio after all fees. So we've been able to cushion the blow on the downside. And as Lou shared our views, what we see happening from here is going to depend on how well the Fed is able to control inflation. And is the Fed going to be able to control inflation without causing a recession? Now, we think that a recession is quite possible. We think it's likely we could even be in a recession right now. We had a decline in first quarter economic growth. 2 quarters of economic decline means that we're in a recession. So we'll see what happens for the second quarter, how the reading is. However, we're positioning portfolios conservatively today. And we believe that in this environment, there are 2 things that you should not be doing. The first is you should not be holding a lot of money in cash. If you hold money in cash, then it's guaranteed to be you're guaranteed to lose purchasing power against as a result of us being in a high inflation environment. So if inflation's at 9% and you're in cash that's earning close to nothing, then your money's not keeping up with inflation. Also, people who've been able to keep disciplined and stay with a stock and bond portfolio in the long term have been rewarded. At the same time, the traditional stock and bond portfolio right now, we don't feel is optimal. I think it's great when interest rates are very low. There's a lot of stimulus. There was a huge amount of fiscal stimulus, monetary stimulus. Now that fiscal stimulus has been going away, the effects of it, and as well as the monetary stimulus is being reversed with interest rates going up and the Fed reducing its balance sheet. So in this environment where there are risks, we feel that a different approach is warranted, and so we have been adding a lot, for example, to alternatives. We came into the year with a sizable allocation to alternatives, and alternatives in particular that can do well in an inflationary environment like we are in today. We actually have one investment that is up this year, an MLP investment as a result of that's in the alternative category, and a lot of other investments that have protected on the downside. And we've been adding to alternatives this year as well. So I'll get into more about individual investments that we're highlighting and changes that we've made. But there is some silver lining, as Lou mentioned. Valuations in the stock market have come down. They were high at the end of last year. Now they're more reasonable, and at the same time, we have a very strong job market. We have consumers in our economy overall have balance sheets are strong, corporate balance sheets are strong, and when sentiment has been low, like it is now, it's actually been historically a better time to invest. And so now that sentiment is low, periods like this have shown that stock portfolio returns starting from periods of low sentiment have been stronger. So there is some silver lining, but we're continuing to manage portfolios differently today and defensively overall. So we're striving to have an all-weather portfolio, one that we can look at the risks, manage the risks, and and have a lot of flexibility. I'll go into specific investments. So why don't we take a look at how we're managing portfolios today. We're defensive. We have healthcare as a larger allocation. We have natural resources, utilities, other infrastructure assets that are less cyclical, so less tied to the economy, and can perform well during periods of high inflation like we're in today. Earlier this year, we moved out of our cyclical investments, went to more quality investments, so highlighting companies that have strong balance sheets, strong competitive positioning, and tend to be more defensive when the stock market is weaker. We're also highlighting developing market stocks. So if you look, I'll show you in a minute why prices are more attractive there. But those markets have lagged over the last number of years, and certain stock markets, like in Asia, have very strong long-term growth prospects, yet their prices are very low. So you're getting value stocks you get growth stocks at value prices. And we've also recently built as contrarian investors, as most of you know, we are not afraid to think differently. As contrarian investors, we've built a position just in the last few weeks in long-term treasury bonds. And those bonds have been, the position that we're building is down 21% this year. We're buying that position because long-term treasuries we feel are a better hedge now. We were avoiding those earlier this year and last year, but now they're a better hedge as their rates have increased. And so we've built a 6% position in long-term treasuries. Our overall bond interest rate risk is still slightly below average. So we're building it from very limited interest rate risk. We're now increasing the interest rate risk and the yields in portfolios. But it is something that is pretty noteworthy, and we feel that if the economy is weak, that interest rates can come down, and this position will actually hedge and reduce risk in portfolios. So why don't we take a look at healthcare stocks, which is one area of the market that we're highlighting now. So why do we like healthcare? Well, this is a picture that shows how many stocks in the market today are selling below the amount of cash on their balance sheets. You'll see here that there are almost as many stocks today selling below the amount of cash in their balance sheets as there was during the financial crisis. The financial crisis being in retrospect, a good time to invest. And if you take a look at which companies here are a big part of that overall equation, you'll see that healthcare there are a lot of healthcare stocks that are selling below the amount of cash they have on their balance sheets is less than the price of their shares. So that means that you're getting their businesses for next to nothing. So that's a sign of distress and can be a sign of relative attractiveness. And healthcare in general is less sensitive to the economy. People are still going to put money into healthcare no matter what happens in the economy. And so it's less cyclical. As a result, as you can see this year, healthcare stocks have performed better than other areas of the market. And at the same time, the prices of these shares are reasonable as a whole compared to how they have been. So we like healthcare stocks. Why don't we take a look at tax-free bonds now? Now, tax-free bonds have often made sense for a lot of our clients who are in higher brackets, particularly those in high tax states like New York, New Jersey, Connecticut, that impose high income taxes on their residents. Last year, the bond market, the tax-free bond market, municipal bond market became unattractive, and we were not buying. We were really holding off on buying additional tax-free bonds as a result. We started to put our money into taxable bonds, and the thing about the tax-free bond market is that it goes in and out of favor. There are extremes in which prices, because it's driven primarily by retail investors, there are times in which the bond market is very attractive and you can get great deals, and then there are times when the tax-free bond market becomes less attractive. So when bonds started to sell off, people started to liquidate their bonds. Individual investors started to liquidate their bonds, and now tax-free bond prices are much more reasonable. And so we are spending a lot of time now looking for additional bonds, looking for additional tax-free bonds for our clients for whom it makes sense. Now let's talk about the international markets. Now the international markets always historically have sold at a discount to the US markets. You'll see here that the average discount on price to earnings basis for international markets compared to the US market has been 13.2 compared to 15.5 over the last 20 years. Now that discount has significantly widened, and it's 11.7 to 15.9. And so we're at multiple standard deviations, close to multiple standard deviations in terms of discounts that international stocks provide. We don't like all international stocks, and we've actually been de-emphasizing Europe. And because of problems in Europe, long-term problems that we see, we've been de-emphasizing Europe. We're now starting to reevaluate our positioning in Europe. So it could be that there's some upside in European stocks now, particularly if things get worked out in Russia. And we see a lot of the long-term inflation pressure coming from wage growth, which is what we have in the United States with a very, very tight labor market. But in general, today we're not emphasizing European stocks right now. We're emphasizing developed market stocks, and particularly emerging Asia and China. And in China, Chinese stock market has been out of favor, and we have growing companies that you can get at value prices. The Chinese stock market is actually projected to grow. Their earnings are projected to be 15% this year compared to 10% in the United States. So you have more growth in China. and you have much more modest valuations. Now, why has the Chinese stock market sold off? Chinese stock market has been out of favor as a result of both increased regulation in China. The Chinese government has since started to reverse and ease the regulation that they put into place last year because the stock market has sold off so much. And their zero COVID policy has, as a result of not having a lot of the elderly population vaccinated, they have instituted a zero COVID policy. But we think that over time they're going to get that under control, and that a lot of the risk is already built into the shares. So we're optimistic about emerging Asia, and which is a long-term growth story as a result of a growing middle class, which is going to play out over the years to come. So that's one. We have more outside the U.S. today, and we also have a larger alternative position. So why don't we take a look at alternatives? A typical stock bond portfolio for an average investor might be 60% stocks, 40% bonds. Well, we've taken money out of both stocks and bonds and started to and created and put it into alternatives. That's been very helpful this year, particularly alternatives that we've been emphasizing, alternatives that have kept up with inflation. So infrastructure investments. You have companies whose cash flows increase with inflation, and then you also have real estate. And so real estate is in that category. And so we've been, those positions have allowed us to have stronger performance, as well as the alternative alpha strategy that we manage. And I'll show you the performance of that. That has significantly outperformed this year, and since we added that strategy in early 2020. So in March, we added to our global infrastructure investments, took it out of international stocks. And as I mentioned before, some of these investments have been some of the best performing parts of the portfolio this year. One of them has actually increased in value. We've also been adding to what's called hedged equity, where you use options to reduce the risk of market declines. You give up some of the upside, but you also reduce the risk. And so we've added to our hedged equity position in April as well. And that has cushioned the blow of the decline of the stock market. Now, why alternatives? Well, let's take a look at the next slide. Alternative investments can behave differently than other parts of the portfolio. So this is a correlation matrix. You see here on the top left, US stocks with a perfect correlation to US stocks. US stocks against US stocks has a perfect correlation. And then you see other investments against US stocks. You see here that the correlations can be quite weak. At the extreme end, you see gold that has next to no correlation to US stocks. We actually had a position within precious metals this year. We recently replaced that position with long-term inflation index bonds. Which we've been highlighting. Inflation index bonds the last couple of years have been performed very well, and we have since replaced we have continued to add to it, and felt that the inflation index bond adding to the inflation index bonds would be a better hedge than precious metals. But you'll see that alternatives can reduce risk in portfolios, because if you have things that will zig when other investments zag, putting them all together can reduce your risk. And the alternatives, we're not adding all alternatives, we're adding alternatives that we feel are attractively priced and can hedge inflation risks in this environment. Let's talk about one alternative investment that's been a standout performer this year. So the alternative alpha strategy is a strategy that we manage internally for our clients, and it's a grouping of ETFs, and the allocation of the strategy can be as high as 10% in portfolios. The reason that we like this strategy now is because it allows us to be very dynamic and to manage risk in portfolios opportunistically. So let me give you an example. Going into this year, the concern was higher interest rates would cause a sell-off in both stocks and bonds. Now, you can hedge that. You can hedge a stock market decline by normally by owning long-term treasury bonds. That's what we did going into the COVID recession and stock market decline. We were owning long-term treasury bonds. Well, but when the risk is that interest rates are going up, you don't want to own long-term treasury bonds because both stocks and bonds will decline as what's happened this year. So what we were doing within this strategy is that we were actually shorting or betting against different parts of the stock market. And so when the stock market started to decline, those short positions started to increase in value. So we can be very opportunistic in managing risk in this strategy. You'll see here the performance of this strategy. This is estimated through the end of June. We just updated it. And so this year, this strategy is estimated to be outperforming its benchmarks by 10 percentage points. Since inception, since we started managing the strategy for clients, it's outperformed by over 5% per year. And the correlation of the strategy is pretty weak against a traditional stock and bond portfolio. So it's been a good diversifier. So this has been a strategy that we continue to emphasize and continue to be very active in. When we move on to the next slide, and I'll talk about another strategy that we have added within the last year. This is the Arden Woods Arden Woods portfolio, and this is as a refresher, this is a strategy that we manage for clients in which we're making direct real estate purchases, and we are seeking to buy these investments, real estate, at significant discounts to the value of the real estate. So we're looking to make our money at purchase. That's why we like it. It's a value strategy, and if we can get the investments at very discounted prices, the real estate at very discounted prices, we feel like we have made our money at purchase, not waiting for the housing market to, or looking for the housing market to make our returns here. So the investments in this strategy are primarily made through public-private partnership programs. Almost, I would say, we have 36 investments in the fund now. It's 35 of them have come from public-private partnership programs, most often through purchases of real estate at distressed tax auctions, and to a lesser extent, we're purchasing them through from local governments directly. So these are tax delinquent properties, and that are normally dominated by mom and pop investors who, as opposed to institutional investors, and we feel like we can outwork them and outsmart them at auction. And so the risk return profile of the strategy for us is very attractive, and we are not using long-term debt in this strategy too. So the historical returns of these investments have been north of 20%, and and that's without debt. So and in real estate as well, real estate can behave independently of stocks and bonds, and real estate has historically been a good inflation hedge. In fact, if you look at what constitutes inflation, we see these high inflation readings. Real estate is a significant component of the of inflation, and so owning real estate can be a good hedge in inflation as prices increase side by side with inflation. So let me give you an update on this strategy. So we're now about 100% invested in the strategy. we'll be making some changes around the margins as we decide which investments to sell and whether to continue to make select purchases. But we're projected to be close to 100% once you budget for rehabs and new construction. We own 36 properties in the fund across 5 states, Georgia, Pennsylvania, 3 other states. Our projected gross return annualized in this fund is over 40%, and then after all fees is projected to be in the upper 20s. So we just got our first property under contract to sell. Just put it on the market a few weeks ago. Now it's under contract. We have 15 other properties that we expect to be sold in the fall. I will show you one of those properties now. The property that we just got under contract. So this property, this is a before picture. It's not the prettiest picture in the world. This is the shape that the property is in after we bought it at tax sale. And we couldn't even get someone to give us a quote on the rehab until we cleared it out. And you see it on the bottom 2 pictures of what it looked like after we cleared it out. If we go to the next slide, this is the shape of the property after the work was done, ready to sell to a first-time home buyer who can finance a lot, all of the purchase, and actually the person is financing 100% that we're in contract with. So this was in an older housing market where rehabs to this standard are not typical, and so is a differentiated product. And our projected return on this investment at the contract price, again, it's under contract now, is 20%. The annualized return is 20%. It goes up to 25%. That's at the property level. It's projected to be 25% based on how we've managed the cash in the fund. So we've been able to increase the return by not only calling the money when we've needed to call the money from investors. This is a healthy return. This is expected to be one of the lowest returning properties in the portfolio, as the other properties that we've purchased have been at more advantageous prices. So again, upper 20s in terms of net annualized projected returns to our investors. We're getting ready now to launch our next fund for our clients. We expect that fund to be available to invest in February, and so we'll start to speak to you about your interest in investing towards the end of this year in anticipation of the February launch. So why do we like this strategy? High projected returns. We take care of the ownership and property management for our clients. We have 3 full-time analysts, real estate analysts, working on this strategy. And we have diversification and it also has an emphasis on strong community development, as well as we are taking blighted and unsafe properties that are often off the tax roll and putting it back on the tax roll and selling it to first-time home buyers, in most cases, often moderate income first-time home buyers. So that concludes my prepared remarks. Now, I'm sure many of you have questions and love to get to your questions and make sure that Lou and I answer what's on your mind and can speak to what you'd like us to speak to.
Thank you very much, Andrew. And thank you, Lou, for your contribution as well with the earlier part of the presentation. And now I will ask a few questions that our listeners sent in. So the first question that we have states, people are talking about the 2- and 10-year interest rate spread. Should I know why, and should I pay attention to this item? Lou, I think this might be right up your alley.
Good. Spread means the difference in yield, and smart people in the know look at these as an indication of whether we're going to have a recession. So as to whether we will have a recession, it is good to watch the difference in interest rate behavior between the 2-year US government and the 10-year figure for signs of a coming recession. 2-year means that's when you get your money back, and 10-year is a longer period. Usually you get a higher yield on a 10-year figure than on a 2-year figure, because it takes longer for investors to get their money back and is therefore more risky. However, investors believing a recession is coming buy the 10-year bond, because a recession results in a drop in interest rates and a gain for the bond investors who's got their money at that time in that particular 10-year. When a 2-year is higher than a 10-year, which is highly unusual, a recession, while not immediate, very often is on the horizon. We have such a spread right now.
Thank you, Lou. And the second question that we got actually, I think, relates back to one of the things you talked about earlier. Why are corporate profits so important, and what makes it particularly important now?
Your salary is what funds your household costs, and for many, allow growth in your standard of living over time. So we can extend that to corporations. For corporations, it is the profit that they earn, which is paid out in the form of dividends to you, or is reinvested in the business to enable the business to grow. Corporate profits are the single most important item for a company, challenged only by sales growth. So by extension, it's the single most important factor for stocks, for investing in stocks. Corporate profits are particularly important today as stocks are down. At the same time, corporate profits today are very high relative to history, which I've shown you, and are projected to continue to grow steadily over the next several years. To me, these profit gains are too ambitious, especially given the possibility of a recession. To me, the reasonable fair value for stocks today, as discussed, would no longer be appropriate if there was anything beyond a flash recession. And I've explained to you how you can take advantage of today's decline in stocks by not looking at the bottom, by looking about what's likely to happen over a 5-year period. That's enough for markets to act, more than enough for markets to act rationally and sell for what they should, and looking at the future for our country. And many people are looking at the future for our country. For example, the dollar has moved up sharply in price because people have more confidence in our country than they do in their own currencies. Many people, anyway.
Thank you very much, Lou. I think that's all the questions that we had gotten submitted in. Thank you, Lou, and thank you, Andrew, and thank you for everyone for joining and sending us your questions. If there's any additional questions you have after the webinar is wrapped up, you can certainly reach out to your advisor. And in case you joined today's webinar late or you'd like to pass Lou's remarks on to a friend, we will be posting a replay of the webinar on our website, and we'll send you an email once this is available. And of course, if you have any additional questions or concerns, please contact one of the members of your wealth management team or call our office directly at 212-406-0850. Once again, thank you for joining Lunch with Lou and Andrew, and have a nice day.